Hey traders and investors, it's Serge Berger here. What I would like to take a look at today is to get a quick understanding of the tensions between the Ukraine and Russia, and then really have a look at the charts and see what they're telling us, what might be the impact here on some of the U.S. Indices and even potentially some single name stocks. So first of all, let's understand that basically what's happening here is that Russia has taken control of a certain part of the Ukraine that has in the past been very much fought over. So it's not a new area. There's Russian naval bases and things like that there. Also understand that basically something like 65% of Russian gas exports transit through the Ukraine to the EU. So primarily, from my point of view, and looking at the charts as well, this looks to be something that should affect European markets, at least for right now, more than it should affect the U.S. market. So if you look at the German DAX here, for example, I'm doing this Monday morning. You can see the DAX is down about 2%, but technically no dramatic damage quite yet. Of course, the Russian markets are collapsing this morning on the back of all the pressure from the G8. And if you look at some of the other European markets, here's a Spanish IBEX 35. You can see right at supported 100-day moving average. You can look at the financials, this is the financials banking index in Europe. No dramatic damage. Yes, of course, a down day. Today, this is a weekly chart, but again, no dramatic damage. If we now flip over to the U.S. markets, okay, let's look at the S&P 500, and we'll look at a couple of sectors as well. So the S&P 500, again, technically speaking, on Friday, of course, on the back of this news, gave us a pretty bearish reversal, although the market did break out. So I think this geopolitical tension here certainly has the potential to bring this market down into the 1820 area. But beyond that, it's a little bit difficult to see and a little unclear right now what the market's doing. So from a trading point of view, there is some hedging activity that can be done. I do think personally, technically speaking, it's just too early to completely sell out of all longs because of the initial stages of the geopolitical risk. If we now take a look at a couple of important things that we need to keep in mind, as it pertains to the indices with the sectors within the S&P, well, most certainly we need to take a look at the energy stocks. Okay, energy stocks, you have all the oil stocks and other things here that are involved, and from a technical point of view, this just is not something that looks like it's going to fall apart. Okay, technically speaking, you have very defined resistance right here. You have a capitulation low that took place in early February, like the broader stock market, and most of the time you don't see triple tops or kind of myths. Yes, can we consolidate here down to the 100 moving average in the XLE energy ETF? Yes, of course. Beyond that, it's a little bit difficult to see how this is going to fall apart. And then you most certainly would want to keep an eye on the industrial stocks, which here too just don't look very bearish. It's just difficult to imagine how this is going to lead to some sort of real bear market type of action. Of course, if geopolitical risk flares up much more than we could see, and there's even war and things like that involved, where the U.S. gets involved, then of course this could certainly change a picture. But from a technical point of view, all things being equal, all else being equal for right now, this doesn't look like it's going to completely take apart the U.S. market. Again, we'll have to take this day by day. But for here, Monday morning or Monday, March 3rd, this is where I think we are. Hope this helps. Any questions, as always, please tweet me at the Twitter handle SteadyTrader. Take care.